Hey, Andrew Malcolm here, Mortgage HQ and Wealth HQ, and I got David Whitburn with me today. He is the author of Invest and Prosper with Property, which I read about 10 years ago, and we had lunch a week or two ago, and I'm so grateful for the time spent and the time now. And David is modest about his success in property investment. Why don't you tell us a little bit about what you've been up to in the last 20 years in property?
After that great lunch we had, be really happy to do that and share the wonderful gift that is property investment. Well, guys, property investment is something there that I absolutely love. It's so much fun being a professional property investor. The market may have interest rates that rise, fall, and there may be some challenges from time to time with different government policies, but through it all, what I can look back on is some really, really fun ventures along the way, and the gains that I've had in cash flow and the gains in my equity as well. That's been absolutely incredible. The journey started a long time ago in early 2002, so just over 20 years ago when I was a young fellow then, and it was a very different market. I was able to buy into a property with 5% deposit down for $140,000, which had big land, over 800 square metre section, and that was pretty good. That was exciting to be able to buy properties like that. So it's still a little bit of work to save up the deposit, but it wasn't too much hassle to do, whereas today it might be arguably a little bit harder, but the 95% loans are, I understand, all but gone. But it doesn't matter, whatever it is, it's still how to do it. The first purchase was definitely the hardest for me, and it involved making lots of sacrifices to do that. In the past, I used to go out and drink and spend over $200 on Friday night, back it up again, another couple $100 on Saturday night, and unfortunately, just when you think about it, with a bit of inflation, things like that's probably $300 each night doing it back to back. That's not really a path to wealth, and my body didn't feel too much better at the end of a weekend anyway. And then you can just rinse and repeat that each weekend, and not too sure if it really took me so many places. So made the decision to do that, and sometimes I might deny myself an overseas trip, or going to spend lots of money going out there, and made the decision to I want to save up there, and I deferred buying my own home to buy investment properties that suited me, and I knew that there'd be a path to wealth from doing it, because I wanted to be able to generate positive cash flow, because sometimes I knew that sometimes things would happen. I had a mate at uni that had cancer, and another one that had some mental health issues, that it was unfortunately unable to work for a period of time. So having these things like passive cash flow is just a good idea in case anything happened there, and it's that positive cash flow that I think is important, because it immunises you against any adverse events in the marketplace. So I started to embark on a strategy to build long-term wealth through property investment, and I have been refining it quite a bit along the way. So that's the very start of it anyway.
The fun thing is you've done so much, so inevitably there's going to be lots of mistakes, and the thing I've noticed is you're definitely not shy about sharing some of the mistakes. And even in your book, which granted is 10 years old now, there's a lot of mistakes from your earlier investing. And I mentioned before you bought your first property, you looked at 45 properties in the area, and eventually got to an auction that you were the only bidder.
That's right.
And
it's hard to lose then.
Hard to lose when you're the only bidder. And we're going to a market now where that very much is the situation. It's a buyer's market. You might only be the only registered bidder, and you even say in hindsight it wasn't a brilliant buy, and then you go on to say the next property you bought wasn't a very good one either. And so now you've built a portfolio where you've probably done over 100 transactions, I'm guessing, and you don't own all those properties anymore, but the portfolio you've kept has been built on learning from mistakes and keeping the good ones. You want to talk about maybe the first couple of properties you bought, what you learnt, and what you might do different?
Yeah, absolutely. In terms of the mistakes, I've learned heaps of mistakes, but the great thing about property investment is you're insulated by so many things in the market, because everybody needs a roof over their head. It's a fundamental human need. So there's a lot of safety in the market. So even with these mistakes, I'm still able to pull out positive cash flow properties there that I was able to, that still went up in value. To this day, I've never lost money in a property project, which is fantastic. I know that that's not always the case for some with a short-term focus, and there can be some dangers with property trading when the market, which now know moves in property cycles. I didn't know that at the start. But some of these key mistakes were not understanding that the property market was cyclical, that it has phases, it has a boom, it has a downturn phase, and then a bit of a recovery phase as well that precedes the boom. So I didn't understand that property cycle initially, so that's where there were some challenges in my strategy for that. Then other mistakes were things like leaving a stable job as a solicitor at a law firm, Russell McVeigh. It had pretty good income, and that was obviously very bankable. The lenders love that. Oh, you're a lawyer, we'll lend you lots of money. It's there to go into self-employment. That one was a defect in my borrowing strategy, and should have perhaps done the purchasing just before that, so I could have done a bit better on that. And then it's the type of property as well, because if I'm not buying property, I have to when you think about property there, what are the elements that you require? What are you buying property for? It's not just for fun. There are easier investments. It's easier to have a term deposit or a gold bar, I guess. But what do you want property for? You want property for cash flow. You want property for capital growth as well, build that wealth. So I was thinking about it and like, yeah, I want that. I want to have more cash flow, passive cash flow, money that works. So it doesn't matter what I'm doing, where I am, what my health is, I'm still going to get paid because my tenants are doing it, and I wanted them to pay off my home loan or mortgage there, and the expenses from it. So that was my strategy, and the mistakes that were made were perhaps not appreciating initially about the importance of the balance for this in terms of being able to balance both the cash flow and the equity side of things, so I could buy. Again, sometimes you can focus too much on cash flow, and then that means that the equity and the growth isn't there, from which enables you to recycle a deposit out to go again. Conversely, the other way around as well, we're focused too much on the equity side of things, and the cash flow wasn't high enough, which then hits servicing walls there to get declines. So it's really important to have your borrowing strategy dovetailing into your property investment strategy. If you don't do that, you won't be able to build a significant property portfolio that provides for all of your financial needs.
Yeah, so the finance is the key part, and that's why choosing the right mortgage advisors and bankers is really, really important, because if you get the money wrong, then you get stuck and you feel like you can't do anything, and then you don't take action.
Absolutely. So that's why I admire the team at Mortgage HQ. They do care. You've got all the spreadsheets and the analysis to do it, and being able to help a number of people to move forward really well by understanding, I guess, these borrowing keys in terms of the cash flow and your equity as well, and it's crucial, and it's great that you keep that in mind.
Yeah, and we do laugh at some of the numbers that you are able to purchase 20 years ago, or even 15 years ago, even 10 years ago.
So like the $140,000
Yeah.
purchase for over 800 square metres 20 years ago. And
Manarua property for 140,000 20 years ago, and then refinancing equity after renovations, and then the next properties. So some West Harbour properties, you told us about a 240K purchase, but it was worth at the time, you reckon, about 280K?
Yep, 280 pre-renovation, then after doing a cosmetic renovation for a shade under 30,000 as they were back then, that's when it got exciting, because by the time I've done that, got the building consent and the resource consent for a minor dwelling back then, which is a 65 square metre secondary house. Not many people do them nowadays, but a minor dwelling is basically just a small second house on it there. It had 3 bedrooms, a bathroom, a lounge with a nice big open deck in it. So that value was able to value up quite nicely at sort of 360,000 for doing that. But by the time I've done it, built that minor dwelling as well. And back then I was able to build them pretty cheap, like 100K to get it all done. And then the cash flow from that's really exciting. That back then in 2004 or so, getting sort of 350 a week from that.
Yeah.
So then that 4-bedroom house attached to it, getting 400 a week plus the 350 a week, the numbers are pretty huge and the yield's really high. So not only was I able to use the 80% rule to refinance out my deposit and a little bit more, I was also getting positive cash flow. That is, I was having more money in the back pocket at the end of the month than I had at the start. and quite a bit. So that was really, really exciting. So of course I wanted to do that again. So I did, and I repeated it. And yes, some of those purchases were bought under $300,000 as well. And others will say, well, David's lucky he bought it back then as well. Yeah, sure, but I don't know, maybe Boston might have skipped the property investment bug, skipped a generation there with their parents, but for the grandparents as well, they were able to do that, and the prices were way cheaper again. So I think we'll be talking very differently in another 20 years' time. I'm not too convinced there that the Auckland median price will be hovering just above $1 million now. It's likely to be a whole bucket load higher than that. So it's just hard to bet against it as well. But
Yeah. If you go back to when your grandparents bought their property in Kohimarama for £300,
yes,
and you told them that it was going to be worth 50 years later or however long it's been, $4 million.
yeah, $1.5 million. Yep, yeah, absolutely.
They'll laugh in your face.
Yeah,
Like
yeah.
you're like, they will think you're a lunatic. And so if you project forward 10, 20, 30 years on properties in Auckland now that are worth $1 million, they might be worth $10 million. It's just the value of that 10 million might be relative to what it is now. The important thing is getting debt attached. If you've got $1 million debt on $1 million property today, and in 20 years' time it's worth 10 million, the debt has helped you hold an asset that's growing in value, relatively low risk.
Absolutely. That's just an amazing deal in Stroo. That's basically a subdivision of farmland quite close to Medill's farm itself, and the aerial photos are absolutely hilarious. The house, and there's not another house around for a couple of hundred metres, and just, yeah, so it does look, in that sense, it does look a bit bat crazy. I think some of his Ponsonby Rugby Club mates, who was president at the time, were mocking him for that purchase. And what are you doing that for, Gil? And he's, watched in his grave for a long time now. I think he'd be having a good laugh there. He was a chippy carpenter, and so was able to build that, and built a 3-bedroom home for himself with views of Rangitoto and the CBD there. Not that there was much of a skyline back in
No
the
sky
50s,
tower.
though. Certainly no sky tower there, but it was actually a really astute purchase to have, and controlled the cost by building on that too, to just enhance that as well. But it does show the benefits of growth and growth over time, because growth to me is the most important element in property investment. You get the growth in cash flow, that's your rents, and the rent increases over time, and the growth in equity, your capital growth there. And that's what's really exciting. That's why property investment is the investment of choice for so many Kiwis. It's something there that we can see, we can feel, we can touch, something we've got a lot of control over, and something that everybody needs. While shares are great, you don't need a share.
Yeah.
Gold bars are great, but no matter how many times you polish them, you're not going to add any extra value to them as well. And there are many other investment choices, and there's a place for them, absolutely. But property investment is fantastic because it's something there that's got the safety, the security of the land as well. And that's why the banks will lend much higher on it than they will against shares, gold, crypto, and things like that.
The forced savings aspect is great because you get the mortgage, you're getting leverage, if you take 20% deposit, you're getting a 5x return on that. And then through the ups and downs, as long as you're committed, it's forcing you to invest through your mortgage repayments. Absolutely. And a lot of people require, myself, I'm happy to say included, is the accountability of, hey, this month you've got a mortgage repayment. Yeah. And it's, it's the first thing that comes out of your account. And so the property, it keeps you on that pathway through thick and thin, as long as you don't bail out. And, I note that you're saying that you're scared of failure, and you are a risk-adverse investor.
Yeah,
that
relatively,
but you're an action taker, and I'm sure you'll give at least half the credit to your success to your other half.
Yes, Bridget's been absolutely amazing. She's a conservative accountant and the CFO of our operation. She's an ex-KPMG, one of the big 4 accounting firms, auditor. So she's got a particular set of skills acquired over a long career that are very dangerous there for me in terms of the fiscal restraint, the beautiful spreadsheets and work papers in there. And there is a role for that. it isn't totally necessary, and it can be handled by others as well in the team if you don't have any accounting skill or inclination, though.
Well, you guys still have an accountant that helps out with your property portfolio, I'm guessing.
They have them
Exactly.
on a silver plate, but we don't
Yeah.
file our own tax
Yeah.
returns, though we have them managed for us by a chartered accountant and tax agent, yes. And we do recommend that. It's just hard to keep up with all the rules, regulation. Don't really want to make a mistake, so we'd rather just pay someone to do that. We think that's part of professionalism, and it's also more professional for the lenders to have independent third parties prepare the books.
Well, what I like to do is talk a bit about the past, the last 20 years of your property investing, talk about how you're seeing things today, and then talk about the future. So if we reflect back, you're 44 now,
Yes.
24 years old, you had 2 properties, you go to the bank, Yellow Bank says no, banker says you're too young to keep buying properties, so you go to Westpac and they say yes. So that's fantastic. You're on this pathway of, at a young age, acquiring more properties.
Yeah.
And so the strategies you used back in the day and what was then is different now. We can understand that. But why don't you talk a little bit about your subdivision experience and strategy, because universally I think it still holds true today.
Yep, absolutely. I started by thinking that it's important to think about what am I doing property investment for? I don't want to retire dependent on the government. I am aware that there are unfortunately some people there that basically have the pension and very little else. I believe I saw a retirement commission survey that had something quite horrific in about how many the average Kiwi had under $10,000 on top of the pension each year coming in. And that
Most
just
people
frightened
don't
me.
have access to much income or savings, and that's
Just
part of what we're trying to help fix is, get people on a property pathway to make sure they will have income for life.
Absolutely, and it's really important to do that. And I wanted to see what can happen, and I got introduced to the Property Investors Association as an inspirational president that was there. Andrew King, who's recently left as the executive officer of the New Zealand Property Investors Federation. He's on a 6-7 month motorbiking trip mainly through Central and South America, which is pretty awesome. Again, through his property cash flow there, and he inspired me. He wrote a great book with Lisa Dudson on property investment that I loved, and I spent quite a bit of time in particular with Andrew King to do that, and liked that I was inspired enough by that and wanted to serve on the Auckland Property Investors Association as well, initially to make sure that I could have my 2 cents worth on something I'm quite passionate about, which is lobbying. So I do like to see more balanced policies with property investment.
More sensible policies and globally normal stuff like tax deductibility.
Tax deductibility of interest, it's just to prejudice that an attack only one industry can't deduct its interest is
And the fact the government doesn't tax themselves on the same competing investments, so the government's saying, "Hey, we are going to invest with an advantage over the Joe Public."
Yeah, it's a bit a pill to swallow, and perhaps not the greatest tax policy ever created, because it does have a ripple effect. It has caused a number of landlords to say it's just a little bit too hard work. I'm going to sell up now to do it, and that has supply and demand to things. Everything's about those economic laws of supply and demand. So we're seeing a number of investors sell, and that is putting some pressure on the rents to go up. Fortunately, the full whack of the interest limitation hasn't come into place, so as a result, the full sales haven't happened yet, but that's coming, and there is pressure for rents, which is unnecessary because that causes the government to have to increase their accommodation supplement, which is a redistribution to pay rents, and it's over $2 billion now.
It's also inflationary, right?
It's inflationary.
Yeah, so once the train starts, it's very, very hard to stop. And I was reading a Sir Bob Jones piece just today that he says when all the economists agree, they're all wrong. And at the moment, all the economists are saying, hey, bit more inflation, and then it will tack off next year. We won't have high inflation anymore. And he's calling bullshit on that. He's saying, I think it'll be 15%, and it's going to be inflationary for a long time. And you've got to remember, Sir Bob Jones lived through very high inflationary times for a long time. That's how he made a lot of money. So Interesting times.
Absolutely. And what asset class do you want to be in a high inflationary period
And
as
what do
well?
you want? You want debt.
Debt, because it gets eroded, but the debt value stays the same, but the underlying asset value goes up tremendously. It's something that we don't really understand as Kiwis too well, the difference between real and nominal house prices there in terms of the inflation adjustment on it. It does get a bit then seen as a slightly academic argument. In the past, it has been with inflation rates sub 2% for so many years, but it's a very different environment now. There are some significant issues, the big energy security issues geopolitically in Europe and North America, as the sanctions on Russia with their friends in OPEC have somewhat backfired, and that will cause continued inflationary pressures. And I guess the governments, many Western world governments, haven't really reined in the purse strings so much, so their expenditure unfortunately is inflationary, so there are some pressures for doing that, but that's a reason why, going back to the original question from you, I invested in property. It was an inflation-proof investment. Why? Rents for countless decades have been intrinsically linked to wage inflation. They basically go up with wage inflation, if not just a little bit higher than that, in big cities like Auckland, which is a migration hub for the country with its temperate climate and all the opportunities and businesses there. So that's why Auckland has just over a third of New Zealand's population. Very few cities worldwide have that, and countries, like not one city countries.
I think it's something like 70% of New Zealand's businesses are Auckland and Hamilton region.
Wow, yeah, I didn't realise it was that high, but yeah, it makes sense.
It's a very, very big number. And of course, if you get wage inflation, then rent increasing, then the yield improves for the property, and investors will see growth in the value of those properties because the market will keep buying based on yield.
Absolutely, the rents have moved tremendously. The whilst has sold some properties, a couple of initial properties in 2002, but can go back to property purchase in 2003, and the rents have more than doubled in that time. So it's under 20 years, have more than doubled on them, and it's pretty exciting, the cash flow that generates. The return on the original investment is just absolutely huge.
So 20 years for some of those properties, what percentage have you had vacancy in those properties in good locations?
My properties are all located in Auckland, so as a result, my vacancies are near nil. I once had 3 weeks vacancy though, which I'm lucky enough to have a pretty good sized property portfolio, number of tenancies. So that's means that I was disappointed though. 3 weeks is still a long time, but what happened was that the tenant miscarried, so was in not a good mental health state. So I said, don't pay the rent. So I'm a bit of a softie, but it's nice to be moral and ethical as a landlord, and I let them out of their tenancy. You said, don't worry about the rent, anything like that, and just let them out. But just took a bit of time. That was at a slightly difficult time. That was in winter 2009. The year prior, we had, I guess, what's known as the global financial crisis, Bear Stearns, Lehman Brothers collapsing, a crisis in confidence with banks lending to each other, and I guess the Reserve Bank did the usual thing and put the interest rates up a little bit too much. So then they had to unwind all the messes as bankruptcies, liquidations, and things came through, and the market was gripped by fear at that stage. So, and it was a nice wet winter then as well. So that's the longest time that I've had, apart from doing a planned renovation or structural alteration or addition on any project, 3 weeks.
So the money's consistent, right?
It's really consistent there. I get really annoyed if I have more than a week's vacancy, and then I've got an amazing manager that really helps do that. And if you've got photos loaded up in good systems, and of course you should do that and have your ads all ready to go, there's really no excuse in a city of 1.7 million people to have any material vacancy rate. If your property is vacant, you're doing something wrong. You're either overpricing it and being too greedy, or you're presenting it atrociously.
Yeah, I was reading again today one of your case studies. You got 2 properties close. One of them was renovated nicely, and one of them wasn't. And the people that ended up renting the nice property had actually been to the one that wasn't nice, and you asked why, and they said, well, we're not having anyone over at this property. It's disgusting. And they didn't realize you were the guy at the same property. Yeah.
yeah, it taught me a lesson not to be lazy on that and actually just go the extra mile to do it. But hey, when you're moving into a property, and I was a tenant for a number of years before buying my own home, it just worked financially better for me to do that and make that sacrifice there. And that's yeah, you're proud when you move into a new home. You want to tell your friends and family that, hey,
Yeah.
it's my new place too. So if it's looking a little bit of a pigsty and the letterbox on a bit of a lean, and yeah, perhaps the guttering could be fixed, things like that, then those things like that, you do get a bit of punishment, and that's an own goal, quite frankly. And yeah, to see if I could get away with it. There's probably a bit of laziness at the time, which I don't do now. I know it's well worth the effort, and that street appeal helps. It helps in your cash flow there for doing it. Didn't need to get revaluations at that current time, but always make that little effort there, and that street appeal is crucial.
So back to what I was asking about. So big downturn, '07 to 2011. Was this when you were doing your subdivisions? Was this when
I'd done a subdivision before. I still don't like making mistakes, and I'm, I guess, a naturally conservative person. Mum was a school teacher then in the media for a number of years, and Dad's was, and I guess still is, a chartered accountant. So yeah, it's a pretty conservative background, and yeah, making mistakes didn't really resonate well. I didn't want to lose any money from any investment. Surely that's the golden rule. So I started off just doing I've done these secondary houses. They're going pretty well for me. So what do I need to do? Oh, let's do a subdivision. And that's okay, yeah, basically, spend 100K by the time I've faffed around, got the plans and survey work done, and do the drains and retaining walls, driveways, and paid council there, a pound of flesh and things like that.
Yeah.
It generally costs a lot more than that nowadays, by the way. But so I did a few two-lot subdivisions initially, and tried to keep the cash flows often not there. So then they ended up being sold and paid income tax and GST on them as a taxable activity. So then I'd move on to doing three-lot subdivisions like that. So I was able to do that. One of them I got caught short on in 2008 as I got a deeper understanding of the property market downturn, so I converted that to a rent to own.
Yeah.
That was a way to keep the cash flow up, but also over 3 years get something pretty inspirational there as well. We had to get some Samoan Kiwis there as first in 3 generations their own home. So got a absolutely gigantic bear hug there. I went to their lawyer's office to do it, to help out with that, and was able to help them stick through everything, through some devastating hurricanes and things like that their families suffered, and just to help them out when times got tough. Yeah, don't worry about that, we'll just skip payments for the month. And they were able to build that wealth, get that plan done, and that was something there that was good. I made good money out of that, and they made great money out of that.
Yeah, and they got the toehold, and then they got the full family committed into property ownership, and that
Absolutely.
so often is the case.
And it was just that was actually really, really rewarding to do. They're a little bit tricky to do and to finance nowadays, unfortunately. So I'm not going to talk too much on that strategy, but that's what happened as an exit strategy when I was finding that harder to sell, to convert to those rent to owns it with that downturn. Then I slowed up for a little bit. I used that as an opportunity, that downturn, to buy, because others weren't buying. They were fearful. There were headlines out in some of the major papers, Sunday Star Times, NZ Herald, property prices tipped to fall 20%, 30%, depending on what month you read it. And didn't really believe it, didn't really see the fundamentals doing that, but some economist or self-proclaimed commentator would think that that's the case. And thought, no, that's not that's there, but I could use it and have that paper with me and show that to the agents there. So then I just can't believe it there as well.
So you could go back and tell them, hey, it's 20% haircut.
And the thing was, I got laughed at there, but it came back 6 weeks later. No one else had put an offer on. I put the highest offer on at the day, and I got that property there, 30% below, with that headline.
So
it's a good time to buy.
What you're saying is how to make money in a downturn is to lowball, in respects of pay the market value, but you have to wait for the seller to understand that they need to meet the market if they want to sell.
Yeah, lowball sounds a little bit crude there as well. On that.
It's
Only because
it's
there's
a
balance on
lowball
that, but I guess
compared to the price before.
compared to the price. Yes. So
what you want is to see the agent laugh in your face, and then you come back 6 or 12 months later when the market has changed, and you make the same lowball offer and it's not laughed at.
Yeah.
Because if it is the only offer, they won't laugh at you. But if there's
No.
10, 20 buyers coming
Oh, then they
and you
would.
lowball,
Yeah, absolutely. And the
yeah.
strategy changes. It's really hard buying the things below value in a property boom. It's a confident market. So many get sold by auction. It's tricky because all the other buyers are there. Unfortunately, sometimes some agents will be a bit naughty and probably get around and crowd some of the purchasers, particularly some of the younger or more naive purchasers there to do it to encourage some bidding. Is a frustrating practice that is evident, but and sometimes people just do it for ego and probably pay a little bit too much on occasion. So it's a tough market. So it's actually a great market to buy because instead of having the market consumed by greed and people scared of that FOMO, that fear of missing out, it turns around, and that human emotion of fear is actually really powerful. A lot of people are scared of losing money, and what if the prices do fall? If they don't fall 30%, what if they fall 15%? Or what if interest rates go up to 15%, like some genius was saying at the radio there last week there? So, well, that's just, they could go up to 15%. Well, no, because that would wipe out too many people and cause a systemic collapse if they were that high. So you need to really apply a little bit of logic and common sense to this, because
The banks don't want the collapse.
The collapse can't afford
They're
it
already
as
making
well.
good money.
They're pretty happy with
They'll
it
do
there
as
as
they're
well.
told in some respects. They don't want any drama.
Absolutely. So yes, there's still some room for interest rate to go up a little bit more, but let's just be mindful of what happens. So that downturn was a good time to buy, and I got some really good deals there. I didn't know how long the downturn would last. I thought it might only last 2.5 years. It really started at the end of 2007, to be honest. That's when the interest rates got hiked to a level. We're floating at sort of 11% or so back then. But it took a little bit longer. Basically, it took 4 years to the end of 2011 for that downturn phase to get out, and then we started to move into the property recovery phase. At that time, spending lots of time doing it. I'd just written my book. Penguin Random House had picked up that they had some really good. Watched a lent a thing or two about having poor sentence structure. That's fine. That's my training as a
Good
lawyer.
at property, not good at writing.
Absolutely, the editor. Yeah, absolutely. The editors changed and did that a lot. Very grateful to people like Amy Hamilton Chadwick, who's editor of Westpac Red News, for the amazing work that she did on that. Tracy Wogan at Penguin Random House did a great job. But they did that, and then was able to launch that to a number of seminars with BNZ, with their property investment team that was formed at that time too. So that was a good way to do that, and the market started picking up again. Banks changed, and let's do 10% deposits for investors, and the market started to come up quite nicely, at least in Auckland in 2012 and 13. So it was a good time to buy again. And the market then started moving to a little bit of a boom phase, not like what we saw in post the first COVID lockdown in 2020 and 2021, but it moved up.
Steady boom.
It was a steady boom, and it was good, just a way to slowly accrete, buy a few more properties, and that was. And that's a bit of fun, and always on the lookout to how to add cash flow. Is there an upstairs, downstairs situation I can do a conversion in? Is there a bit more land on it that I can either subdivide? And I still hit financial walls and that started to come up. It means that to keep moving forward, I'd need to use other strategies.
Yeah. And making money in a downturn is a mindset. You can say, hey, look, I'm going to wait. I see a lot of people just wait and wait and wait and wait. And then what are you waiting for? There's deals every day.
What if the market to go down further, you see, Andrew? If I just wait a bit more and then people tell them you're silly, their family and friends can hear, their workmates.
Well, have you bought properties and then the market went down, and so the value of the property went down? What happens? The market goes back up again.
It goes back up again, and when in some cases they've tripled. So am I sad that I've got over 300% on that, on something that's given me over $200 a week on average? Not really. No, that 10 grand a year is quite nice to have. It's actually now I was lucky enough to fix in some last year at some good rates, so it's over 20,000 a year from that property. I'm not remotely sad there, but I guess if I had valued a property purchase in 2007 at perhaps a low point in the start of 2009, it may have gone down. It might have even had some, I might have lost 20 grand equity to that, but no, I'm pretty happy there to have
You
over
bought well.
600,000 of equity now, and about 23,000 a year passive cash flow from it. That's not particularly stressful.
Yeah, yeah. So at what point did you get to where finance was tougher and you didn't have the borrowing power anymore because you maxed out? You start looking at joint ventures.
Yeah, needed to do that. As you grow a portfolio, it gets harder to hit the cash flow servicing. So banks might call them sensing sensitivity margins, applied interest rates, test rates, those kind of things. There, the equity I found I'm good at creating equity and building that because I'm good at buying and very good at developing. For others tell me so. So I can manufacture equity pretty well. Cash flow is a bit harder on residential. Absolutely, it's intrinsically linked into the wage inflation, and you're capped by by market and the market forces. You can't go too much above what any neighbours are doing and things like that. So I hit walls there, and I like developing. I had already prototyped my 1 lot subdivision, my 2 lot subdivisions, 2 extra lot ones, and 5 extra lot subdivision things, and then it was, wow, we're getting this medium density housing. It's something that's been around in the inner suburbs for a while. Sydney and Melbourne are great precedents for that. London as well, and many European cities are fantastic at that in particular. But Auckland's a pretty new thing, so that was something there that I needed to get a bit of extra capital and wealth, and so to do a number of partnerships there that have helped, because by the time I've done that, by the time you get the plans sorted, the resource consents and building consents and build them, they're not quick projects. Love them to be, but they do take time, and that's something there that's got to be mindful of. But the returns are pretty attractive from doing it.
Your strategy has been, when you don't have your borrowing power or your own capital that you want free to release, is to take charge of a project and
Yes.
offer partners your basically management skills of property development and to get things done. Say, hey, you put capital in and you invest with me, and I'll get you a return.
Yes, that's right. That's the model. Yeah. So joint venture style of doing it there. I guess in some cases there might be pulling together people that I know and deal with quite well, and basically a group of friends coming together to buy property, like a syndicate, a group of 5 friends coming together to, hey, let's come and let's do this and set the rules up there. I'm overweight and lawyer friends, so I've been doing that with a few with a few of them, and it's
they're cash rich, time poor,
very
and
yeah.
you're a former lawyer, so they trust you, I guess, and that.
Probably not for my legal skills though, but
Not
more for my development skills on that. I really try to pay attention on construction law, and that's a field that I am quite passionate about. I do like that, and aspects of trust law, but the other fields don't really pay too much attention to. Happy to pay the lawyers for their expertise for doing that, but it is a good way to do that and to build wealth as well. I have been pivoting my portfolio a little bit towards commercial property as well. Bought a childcare centre a few years ago, and that's a great performer in the portfolio. And I'm keen to acquire more commercial property as well. It just has to be the right type of commercial
Would
property.
you do conversions, or you buy as is?
I do conversions very happily. I
Yeah,
think
you're
conversions in
adding
this market
value.
are quite good
Yeah.
deals on them as well, to add value, and just the lead time. By the time you've got all your plans together and then getting the resource consents and building consents for new projects, it can't be underestimated. The
Yeah,
lead
and then
time
you
is
get somebody to come in and run the centre, or that's part of you.
yeah, absolutely. So get a good trusted operator, and it's so important to do that, because commercial property is all about the tenant, the strength of that, and the income
10
there.
years.
Yeah, you want a decent long-term initial lease as well. Ideally, depends on the type there. For some smaller retail properties, not my favourite sector, but it is an affordable entry point for so many there. Those 10-year leases are going to be harder to get, and in many office cases there as well. But yes, I personally love at least terms of at least 10 years.
So tell us about this development you're doing out in Ranui.
I'm doing a big development that's it's 74 terraced houses. They're It's in Metcalfe Road in Ranui near the Ranui railway station. It's 1 hectare of land, pretty flat. The land, they were all pre-sold off the plans in late 2020, early 21, and we're really advanced through the construction. Got the code compliance certificates on the first two. All of the units have had their civil works completed. The last ones have just had their, I guess, the subfloor, the foundations down, the big deep piles and things like that for them, and got a number going up for finals next week as well. So that's a pretty exciting project. So it's got 11 blocks to it. So yeah, huge project.
A lot of work.
So lots of work there, a lot of fun. Project managing that, getting the titles, and working in with that. It's I've got a great business partner, and on that too.
There's a
really
construction
helpful there.
partner as well, right?
There's a construction company that's doing that. Yeah, I guess they're a construction partner. Yeah, absolutely. They're working hard with their teams to do it. It's been a challenge. We had all 74 lots of plasterboard cancelled, unfortunately, at the start of the year. So it's been stressful with the material and the procurement. That's all but over now. A few of the niche products like
You're earning your
seed
money.
and things, but yeah, you got to earn your money on this. And right now, the construction inflation's really tapered back. It's pretty minimal now, but in the past it was quite horrific, and there were real supply issues, and COVID impacts were observed, and for some suppliers, not really impacting the site. I think talking to the construction guys, I think we only ever had 5 away at any one time as the maximum there. Some days, one of the toolbox meetings that I attended had 81 people on site. So
Crazy.
it's pretty impressive, a busy project, a lot of fun, but that's not for the faint-hearted. But proud to do that, deliver for a number of homeowners and investors.
Yep. So you originally got that deal under contract, or did you own the property and then create everything?
Bought the deal actually originally planned to do that for Kiwi Build, had that signed off by the regional manager, then the CEO. Kiwi Build have, be fair to say, have had some problems and they didn't get ministerial approval for whatever reason, so those Kiwi Build apartments then got converted into terraced houses, so that's okay, but again, just put another 150k onto the price there to do it, and doesn't really hits quite so many targets, unfortunately, for the first homeowners, so that's a change in the project, but I guess it's a greater feeling of space, and the car parks that all but 4 units have, and the landscaping's of a much higher quality.
Yeah. So before we go on to what you're going to do from now, summarizing the lessons you've learned in the last 20 years, if you assume somebody's, say, late 20s, early 30s, they're just getting started in the property game, what are you going to suggest if they don't have much of a starting point? Not everybody has parents that can give them money.
No,
Not everyone has a big deposit or a high income.
No, I didn't have that luxury either. So you've got to, unfortunately, make a few sacrifices to save and get that first one, because the first one is by far the hardest. And unfortunately, I do observe that without making sacrifices, it's really hard to get that success. So it is actually worth so much to do it and to get that rung on the board there. And on that first property, what is it as well? Where is it located? Some people think that I might just buy this property in Kaikohe up north because it's cheap and I can afford it. But does that area have some of the factors that are going to give you good rental growth and good capital growth? Possibly not, and I don't know enough about Kaikohe. I haven't analysed it, but I'm worried that we don't have the population growth there. It's not really renowned as a migration hub. Does it have the infrastructure there to give it everything that needs further growth, the employment factors, perfectly nice town, things like that? But I'm just wondering if there are areas that may be a bit less risky there, that are more likely to have higher rental growth and higher capital growth prospects. So sometimes it's about not compromising and buying that property in a small isolated town, as opposed to buying in a main centre there that's got a lot more infrastructure and investment coming there, because it's about the jobs, really. The employment factors are important, the infrastructure it's in, and that's where population growth comes in to do that. So then it's figuring out what type of property is it. is it going to have to be a new build because I don't like the interest limitation rule, and I think that having a 20-year private extension
This
is
might
good.
be their first home, so
If it's their first time, then that's
yeah,
a
they
great
might
thing
have
there.
to travel a little bit or get a job that allows for remote work. And if you don't have a job that allows for remote working, then partnering locally with a couple of friends to get into something that, say, if you can only afford 300k now, you can buy a property in Invercargill, or you could pool your resources with a few friends and buy a 900k property in Auckland that needs a bit of elbow grease and do the work yourself and
Absolutely, and get borders in
yeah,
potentially to
get
help
bored.
out.
Yeah, and it doesn't have to be your forever home. And
No, shouldn't be.
if you, most people that have a job are going to have borrowing power of 300k plus,
Hmm.
and it's a matter of getting yourself to that collectively 20% deposit, with KiwiSaver, with selling cars, with pooling resources if that's what it needs to.
Yeah, absolutely. And for some, they might take a path that I took, which is to rent first. So you can actually rent in quite nice areas there because it's quite a bit cheaper than owning a home and have that investment property or two or five. So that's another thing. That's certainly by no means a mainstream idea, and a lot of people want that security of a tenure that they get from having their own home and that comfort. So I don't want to begrudge any of it. I realise that what I did there is not normal, and I'm in the minority of people that have done that, but it does give you some really good financial results there. So I would encourage some of the viewers and listeners to be open to considering that idea and chat to your advisor about that.
So what's happening in the market now? You're in a position of, you've had hundreds of property transactions that you've been involved with.
Mm.
You've got a good amount of debt. You're a property investor full time. Like, what are you thinking? Like, how are you thinking about interest rates, about property buying, property selling? Like, what is your mindset for the next couple of months?
Yeah, sure. And in this very short term there, I do think there's a little bit of risk that the interest rates will go up a little bit more. They're going to have to take a break soon because they don't have a meeting until next year. They have a bit of a long Christmas break at the Reserve Bank Board of Governors.
Lucky for us, huh?
So they're probably lucky for us to do that because I do think they tend to overreact. Unfortunately, I quite frankly think they should adopt a wait and see approach, because if they were actually active in the market and not in their ivory towers in Wellington, a bit oblivious to what's going on with the heavy insulation and government jobs there, the economy does have a lot of challenges at the moment, and there's a lot of people that aren't confident. A lot of money that has been put into expenditure, which is in the historic data, so they pick up the data in arrears from previous quarters and then add another month for it to get washed through. That means that they are looking at, they don't have the most current up-to-date situation, often sort of 4 or 5 months late, and the issue with that is things are changing, things are turning. There's not so much confidence out there. Some of the businesses are deferring some of their hiring and expansion decisions. The wage inflation that we've been seeing is not there. Many people there with their home loans and investment property loans are unable to pay for as much as they could in the past, so they're not spending as much. And a lot of people are a little bit worried about things, and the price rises going up. So they're trying to actually start saving a little bit more money, so which I think is a prudent thing to do. So their work's already largely done. I personally think they should probably leave it for quite a while. I don't know if they actually need to do any more. What will they do? Probably another rise, and they've indicated they may well be doing rises to mid next year. So further interest rate rises are likely. That will put pressure on the interest rates. Of course, they'll follow the shorter term rates in particular, will track upwards as well, and who knows, might be having floating rates at 8.5% or something like that. Hope not, but there's a real risk that is. But how long does it stay for? Well, that's the interesting thing, because what happens is that when the inflation rates can get under check, because currently the Reserve Bank are required to keep trying to have a target band 1 to 3% as their target band for inflation. So they're having some real challenges with doing that, and there's these temporary and transient inflation comments that we've had from our Reserve Bank Governor previously, mirroring those from the Reserve Bank of England and the Federal Reserve Governor Janet Yellen's comments there, perhaps aren't quite right, and it is a bit longer. I think that they thought that with a bit of backing they'd be able to do this, and these sanctions will just absolutely destroy the ruble. However, I know from I guess investment banker friend that the ruble is one of the top performing currencies this calendar year. I know from my father-in-law's friend, a former customer of his business, that his family are dealing with rolling power strikes in Germany, and businesses aren't getting supplied power. The power prices have, I think, gone up 5 or 6 times, is what it's saying, and it's quite frightening. They're losing. There are protests that don't really get reported, which is really sad, in the likes of France and Germany, because people are cold, people are hungry, and these sanctions have backfired. They've cost Truss and her leadership, quite frankly, as well, with the inflation, the energy crisis they've got. Some say that I heard that on ZB that US had something like 23, 25 days of diesel supply left. It's quite frightening to do
Yeah,
that,
that
because
is a bit scary.
how are you going to freight everything around? The electric trucks sound all good, but
Well, they've
just
got
aren't
some
really-
droughts in America at the moment, and a lot of America is run on the rivers. So
Yes.
they have barges going
That's
both
right,
ways
the
usually.
Mississippi system, yeah.
And so what's happening at the moment is droughts and the rivers going down, so the barges can't operate it as much, and they're actually only operating one way.
Wow.
So what's happening is the barge prices are skyrocketing and availability is declining significantly, and they're usually 100% full anyway.
Wow.
And so a lot of the barge activity is for energy as well.
It is. It's a really, really tough time, and that energy security thing, I think, is important. OPEC showed their colours by cutting supply quite dramatically as well as it moved to support Russia. This war there that we do get frustrated, because I do wonder. I hate wars, by the way. I think it's awful, but it's just going to take a really long time, because the economic war is an abject failure, and there should be pressure exerted on Zelensky to come and meet and get some solutions set up, because this war's got to end. It hurts too many people. People are getting
Greater
caught up
things
in
at
this
play
fight, and it's a
for,
shame.
yeah.
Again, hate wars and don't condone anything that's happened there. It's all horrific, but I just want to see an end to it, and there is absolutely an economic impact to that, and try not to take any sides to it, and just figure out that some solutions, what would be great to do, because it is going to cause a lot of pressure there, and that will cause that's a major part of inflation there. And I think we've got some big headwinds next year for this as well. And it's not just that; it's some of the food products, grains, like wheats and things like corns and things like that that do ripple on from that too. So that's something that we need to address. And then just things like our trading relationships as well. Australia's trade relationship with China has been tumultuous and hasn't been so successful. We have the unique position there where we are a lot softer than Australia and have a good relationship with China. Australia is still our number one export partner, though, so that's good for now. So we have to be mindful of that. But see just even earlier today, the things like the dairy commodity prices, the milk powder prices came down again for a third consecutive time, and I think over 6%. So there are a few headwinds there that are slowing things up, and that's all these things combined pointing towards things like a change of government next year, with the opinion polls showing that that's likely. That will have impacts on probably things like the interest limitation rule that National Act NZ First parties haven't been fans of. I think that we will have a change of government next year is looking likely, and I think that we will have more policies there. So in terms of you asking me about the next 2 months there, I think gentle interest rate rises is unfortunately the order for the day. But I still think that what's going to happen is there'll still be the odd good deal that comes up, because some people have to sell. It's not the greatest time to sell property right now.
No doubt about it, yeah.
If you have to sell, though, then you have to sell. You're moving, city, place, job, whatever it is, downsizing there, upsizing, whatever it is.
Yeah,
you
the
just have
cost
to
of
do it.
waiting is so high, and
Could it fall further as well? We don't know.
It could fall further. You can't put your life on hold if you want to sell, and the thing is, what you're benchmarking against is a ballooned price from last year, and that price from last year was far above the trend line of growth, and so it wasn't. It was just, if you sold at that time, it was good for you, and if you wait, then
Oh,
and you've got to take the
absolutely.
ups and downs of your own property.
It's so artificial that 40% gain that we had since that first COVID lockdown, yeah, ending in whenever it was May 2020 to towards the end of last year, to go over 40% was absolutely massive and basically unprecedented. But some prices, basically last year's work's getting rolled back.
Yeah. So you finish this development soon, everything's sold. What comes next? Are you gonna do the Charlie Munger and go invest in business or commercial? Or are you gonna stay in property development? You don't really know. Like
No, no,
you're gonna have a bit
absolutely.
of a windfall.
It's bit of a windfall though as well. But I think it's a good time to buy a property as well. There will be some good deals that come up, that are opportunities where I'll put in a price that's arguably low. But if it's the best offer on the day, then great.
There's
Then
lots of
grab it.
developers that have to exit out of properties that they've earmarked for future potential a few years ago, and they've miscalculated their timing, or
Oh, I've been frustrated by COVID and things like that,
yeah,
and
yeah.
material delays and issues. Yeah, I might even look to buy some deals to complete some projects there that are just second, third tier lenders, small lenders just run out of patience and time and just need to get it finished. So I'd look
Well,
at some
what's
receivership or
happening? Yeah,
mortgage sales. Yes, absolutely.
a
In
lot of
developments.
developers are getting caught out because they have to refinance or extend their non-bank lending, and they're getting hit with another round of fees. And so if you don't understand, the development market is very common to be charged 1% application fees, maybe even up to 2% application fees. So if you're borrowing 2 million, and so you've paid those fees a year ago, if you haven't finished your project and you need to redevelop, then you get to a point where you have to pay fees again to reapply for that lending. And it's not the interest rate that's killing you, it's the capitalization of your application fees, because you can't always capitalize them, which means you can't always add them to the loans. It means you have to come up with the cash up front to get the finance. So it's
Absolutely.
somewhat ironic. A lot of developers have to pay money up front to get finance to do, and they can't do it. The
No, cash
cash
comes at
flow,
the end because you have to
yeah.
get your titles. And
So yeah, cash flowing your financing your development is a very, very important part of being a successful developer. And unfortunately, a lot of developers are good on the tools and not good with the money. And
Yes,
spreadsheets,
it's true, and we have the largest numbers here. The banks and bank property finance units, bankers tell me in particular, to be pedantic, they tell me that there have been a lot of just some standard people, often with jobs there, that have been doing some smaller, medium density housing projects, and they are struggling a little bit with it and have been caught up with it. So most projects have been going over
I've
time, of
seen it
course.
a bunch of times. People have come to us with millions of debt. They want to refinance, and what eventually comes out of it is they've been working on property developments and they're actually in hardship, and they don't declare that up front. They're looking for a desperate out. And
Yeah.
if you're in hardship, it's very, very hard to finance out of it.
It is. It's tough to do it. It's so absolutely so easy to do that, and there are too many that are in some harder times. Unfortunately, the times are looking a little bit tougher too, and many of the lenders are starting to be a bit more aggressive in protecting their things when they've gone over the loan term by material things, and in some cases they just can't. Some cases they're being a bit naughty and potentially wanting it to fall, which is unfortunate, but it's just a risk that's been taken. I am looking at some commercial property opportunities. I think there are some good commercial ones out there, so that's something that I am quite attracted to. And from doing this, taking capital out and the profits of the large West Auckland development out, it will give me a chance to do some slightly bigger deals too. So I'll be looking at doing that, and if the deals stack up and hit my conservative criteria there, and are safe enough but good deals, the ones that like to work with you and your Capital HQ team on as well.
One of my friends he's done well in business and sold. He owns a $15 million property, and it's a 600K rent. You know, that one deal is gonna be fine for him. And you say, how do you possibly get a $15 million property? It's a lot of hard work with property investing and growing a business over a long period of time to make that big deal right at the end.
Absolutely, the huge, and I really admire him for the discipline, the focus, and unwavering desire to achieve that level of success is fantastic. And we've seen
Yeah.
many more that don't want to keep seeing the success stories done, and on whatever level. The market will be in for a little bit of a tough time for now, but as surely as day follows night, the market will rise again. Rents will rise, and the values will rise as well, and these interest rates will go down. We just have to ride out what this is a storm. It's a little bit of a storm, but like all storms, they eventually go away, and the bright sunshine will be there to stay.
Oh, that's a good place to finish. So, invest and prosper with property. Are you still printing these? You still buy
No,
them?
no, that
They're
one's
out of print.
out of
Oh,
print run, unfortunately. So you've
yeah.
got one of the rare
I got a
copies
special copy.
of them. So yeah, absolutely. But your book, The Three Property Formulas, is a great one that I highly recommend as well.
Yeah, thanks. I appreciate that, and hopefully we'll see more of David online.
Oh, thanks for the
coming up.
invitation, Andrew. Really appreciate it. And yeah, look forward to talking in coming months.
Sweet.